Level 1. $8,000 a year. Level 1. You made $8,000 last year. Not enough to live on, enough to owe. You don't know how to file, so you use the free software. The one that runs ads during football games and promises maximum refund guaranteed. You answer the questions honestly. You don't know which boxes to check, so you guess. You file on April 14th because you were scared to open it sooner. The software says you owe $340. You don't have $340. You set up a payment plan. $25 a month. You can do $25. Then the letter comes. IRS. Letter 566. Your return was flagged. Not because you tried to cheat, because you made a mistake. A W-2 was missing. A form you never heard of wasn't attached. The letter says you owe $1,800 now. Penalties. Interest. The mistake cost more than the tax. You ask about an appeal.
I just want to know why it jumped to $1,800. That's it. That's all I'm asking.
They say yes. You hang up. You stare at the letter on your kitchen table. The same table you eat dinner on. You don't eat dinner tonight. The penalty at this level isn't financial. It's the message. The message is, the tax code was written for people who can afford to read it. You can't. Level 2, $38,000. Level 2, you got a real job, wage 2, $19 an hour. The taxes come out before the money hits your account. You don't think about this. That's the design. You file in February because you want the refund. The refund feels like a gift, a bonus for surviving the year. It isn't. It's your own money. You overpaid by $1,400. The IRS held it for 12 months, earned interest on it, and returned it in April like they did you a favor. You gave the federal government an interest-free loan. Nobody tells you this. You're in the 12% bracket. On paper, you pay 12 cents of every dollar. In reality, between FICA, state tax, and the things the software doesn't optimize, you're closer to 20. You don't know that because nobody shows you the real math. Your coworker mentions he itemizes. You don't know what that means.
I don't know what that means. I don't understand.
You take the standard deduction, $16,100. Everyone at $38,000 takes the standard deduction. It's the default, the path of least resistance, the path that costs you the most. You don't hire anyone. You can't justify it. Why pay $400 to save $200? The math is correct. The logic is a trap. The tax software charges you $79 for the deluxe version because your return is slightly complex. You don't know what made it complex. You pay the $79. The refund covers it. The system doesn't punish you at $38,000. The system just keeps you in the dark. And the dark is profitable. Level 3, $75,000. Level 3, you're middle class now. The word means less than it used to. You crossed into the 22% bracket. You felt it. Every raise from here gets taxed harder. The government becomes your silent partner, taking 22 cents of every new dollar, plus FICA, plus state. You still use the software. It asks if you want audit defense for $49. You buy it. Fear is a product at this level. Fear is sold to you in a checkbox. You start hearing things. A friend tells you about a guy who writes off his truck. Another friend says that's illegal. You don't know which friend is right. So you do nothing. Doing nothing feels safer. Doing nothing is expensive. You get a refund again. $1,900. You put it toward a credit card. The same credit card the tax code doesn't care about. The IRS doesn't care about your 24% APR. The tax code doesn't care that you're paying more in interest than you save in deductions. You hear about Roth IRAs, 401ks. You contribute a little, maybe 5% with a match. But these accounts have limits. $23,500 for your 401k, $7,000 for your IRA. The limits are low enough that you can't meaningfully shelter your income. They're big enough to make you feel like you're doing something. The tax code, at this level, is a wall. You can see through it just enough to know there's something on the other side. You can't reach it. You're not punished at $75,000. You're just locked out of the rooms where the real decisions happen. You pay your share. more than your share, and you don't know it. Level 4, $165,000. Level 4, something shifts. Not in your income, in your options. You hire a CPA, a real one, not a strip mall chain, not a kiosk at the grocery store, a person with a nameplate and an office. She asks for your last 3 years of returns. She spends 40 minutes reviewing them. Then she looks up and says something that makes your stomach drop. You've been overpaying by about $4,500 a year. $13,500. Gone.
Wait, 13,000? That's real money. Nobody caught this? For 3 years?
Because you didn't know what you didn't know. She finds things you'd never heard of. Home office deduction. Business expenses you never claimed. Bonus depreciation on equipment you already bought. The words feel like a foreign language. The numbers feel like someone just handed you money you'd already earned and couldn't reach.
I don't even know what half these words mean. This was already my money. I just didn't know how to get it.
She files amended returns. You get a check for $4,100 from the IRS. The United States government just admitted you overpaid and sent you your own money back with 0 interest. The system didn't change. Your access to it did. You start planning, not just filing, planning. The CPA asks about your goals, your timeline, your retirement. The conversation shifts from what did you make to what do you want to keep? The difference between those two questions is the difference between this level and every level below it. You're in the 24% bracket now, but your effective rate, what you actually pay, is lower than what you paid at $75,000. How? Because you stopped playing the game everyone else plays. Level 5, $300,000. Level 5, you're not an employee anymore. Not really, you have an LLC, elected as an S-Corp. The CPA suggested it 2 years ago. You didn't understand it then, you understand it now. You pay yourself a reasonable salary, $95,000. The rest comes through distributions. FICA doesn't touch distributions. You save $15,000 a year on a structure that exists because the tax code was written by people who own things, not people who work for things. You're in the 32% bracket now, but your effective rate keeps dropping. You lease a vehicle through the business. Section 179 deduction. You deduct your home office, 200 square feet, $5 per foot, that's $1,000. Your phone, your internet, your laptop. The things you were already paying for now reduce your tax bill. The system isn't punishing you anymore. The system is opening doors. You hire a tax strategist. Not a CPA who files, a strategist who plans. The conversation changes again. SEPIRA. You put away $69,000 pre-tax. At $38,000, you couldn't save $200. At $300,000, the system pays you to save. Every dollar you set aside avoids 32% federal, 15.3% self-employment tax, plus state. You're not saving money, you're buying a discount on your own income. Your kids are on payroll, legitimate work. Their salaries are deductible. Their Roth IRAs get funded with pre-tax dollars. The family tax bill drops by another $12,000. You realize something at this level. The tax code isn't a wall anymore, it's a menu. And you're finally reading the right pages. Level 6, $600,000. Level 6, you own a business now, a real one, multiple entities. You're in the 35% bracket on paper. In practice, you haven't paid 35% on anything in years. The tax strategist becomes a team. An attorney joins. A wealth manager. The three of them meet without you sometimes, then present options. You don't apply for tax strategies anymore. Strategies apply for you. You buy a commercial property for the business. Cost segregation study. The depreciation schedule saves you $28,000 this year. Bonus depreciation on the improvements. You didn't know those words existed at $75,000.
3 years ago, I didn't even know this word existed. Now it's just a line on a spreadsheet.
Now they're line items on a spreadsheet that saves you more than most Americans earn. You hire your spouse, legitimately. She handles operations. Her salary is deductible. Her retirement contribution is deductible. Her health insurance is deductible. The family tax bill drops by another $18,000. You start a defined benefit plan. The contribution limits on a cash balance pension plan are enormous, $275,000 a year pre-tax. The math is absurd. At $38,000, you could put away $7,000 in an IRA. At $600,000, you can shelter $250,000 and call it retirement planning. The IRS doesn't audit people like you. Not because you're hiding anything, because you have better documentation than they do. Your CPA's office has a dedicated audit response team. The IRS sends letters, your team sends binders. You're not playing the same game anymore. You're not even on the same field.
Level 7.
$2,500,000. Level 7. You're in the 37% bracket, the top marginal rate, the highest the IRS can take, and you barely pay it. Your income doesn't look like income anymore. It looks like long-term capital gains, carried interest, qualified dividends. These are taxed at 20%, not 37%. The difference is 17 cents on every dollar. On $2.5 million, that's $425,000 in taxes you don't pay. Not because you're breaking the law, because the law was written with this exit built in. You have a family office now, a dedicated team that does nothing but optimize your financial life. They find credits you didn't know existed, opportunity zone investments, conservation easements, historic rehabilitation credits. The tax code is 6,871 pages long. Your team has read every one of them. You make a charitable donation, not just cash, appreciated stock. You avoid capital gains tax on the appreciation and take a full, fair market value deduction. The charity gets the stock. You get the write-off. The IRS gets nothing on the gain. You buy municipal bonds, tax-free interest. The federal government pays you to lend it money, then doesn't tax the interest it pays you. This isn't a loophole, it's a feature. Your tax rate doesn't look like 37%, it looks like 14%. The system isn't a wall anymore. The system is a partner. And you picked the right partner. Level 8, $25 million. Level 8, you don't file your own taxes anymore. You haven't seen a 1040 in years. You have a team. A family office with a chief investment officer, a tax counsel, and an estate attorney. They meet quarterly. You attend when something needs a signature. Your wealth isn't in your name, it's in trusts. Dynasty trusts, grantor retained annuity trusts, GRATs, intentionally defective grantor trusts, IDGTs. The names sound absurd because the people who named them didn't want you to know what they do. A GRAT lets you transfer appreciating assets to your heirs with virtually zero gift tax. The math. You put $10 million in a trust. It grows to $14 million in 2 years. The $4 million gain passes to your children tax-free. This is legal. Congress knows about it. They haven't closed it because the people who benefit from it write the laws. You borrow against your assets. You don't sell them. Selling triggers capital gains. Borrowing triggers nothing. You live on $800,000 a year in loans secured by a $25 million portfolio. The interest on those loans is deductible. The gains on the portfolio remain unrealized and therefore untaxed. Buy, borrow, die. When you die, your heirs get a step up in basis. The $25 million portfolio, which you bought for $12 million, resets to $25 million at your death. Your children sell immediately. They pay zero capital gains tax. Zero. On $13 million in gains. The estate tax exemption is $13.99 million per person in 2026. Married, that's nearly $28 million you can pass completely tax-free. Above that, you have irrevocable life insurance trusts, charitable remainder trusts, and about 40 other structures that make the 40% estate tax rate a suggestion, not a rule. You pay less tax as a percentage of your wealth than the person making $38,000. The system doesn't change. The system reveals what it always was.